Hello, everyone, and welcome to a new episode of Perspectives Live. My name is Pietro Calandra. I'm Refinitiv Sales Director for Pricing and Reference Services here in Northern Europe. It's my pleasure to be hosting today's session from our office in Paternoster Square here in London. In today's episode, we'll be discussing the standardized approach for FRTB, so the fundamental review of the trading book. We'll specifically be looking at a few aspects of it, especially what it is, what it entails, and especially the key changes we've recently seen to this approach, but also importantly, focusing on the main challenges that we're seeing banks are currently facing and what the necessary data requirements and considerations are likely to be to tackle these challenges, especially on the data front, as we know that they can be vast. Finally, we'll be looking at how together Refinitiv and Yieldbook can provide help and support. And today I'm joined by my LSEG colleagues, Fausto Marseglia, who is our head of product management for FRTB and our regulatory propositions, as well as Attika Raj, who's our regulatory analytics product lead for our Yieldbook business.
Hi, Pietro.
Welcome both. And with that, let's dive straight in. I'd say Fausto, hi, and I'm gonna come to you first with one of my first questions that I'd be interested to get your kind of view on. FRTB has, we've clearly seen it that it's been one of the key priorities for banks from a regulatory point of view in the last few years. Can you quickly remind us, first of all, what FRTB is? When is it going to be implemented? And now that we're talking about the standard approach, what is it?
Thank you very much, Pietro, and a warm welcome to everyone from me as well. So FRTB, as you rightly said, it stands for Fundamental Review of the Trading Book. It is a market risk regulation that aims to ensure that banks are sufficiently capitalized, that they have sufficient money for navigating situations of financial crisis and for offsetting risks that have in the trading book, right? So typically banks trade on multiple instruments, prices go up and down, and consequently, they can be in a bad situation in a financial crisis, right? As we saw in 2007, 2008. The word fundamental of the regulation means that it is actually a deep change of the previous regulatory regime, which is also known as Basel 2.5. Okay, and one of the big changes that was applied is that now the capital requirements calculation is done at single desk level, right, and then aggregated at at enterprise level. That's a big change, to the previous regime. And banks have two different ways for calculating capital requirements for every single desk. They can go they can use the standardized approach, the SA, which is a subject of this event. And this is actually a standard methodology which is the same for every single bank. Or in alternative, and this is particularly relevant for the big regional and global banks, they can decide to use the internal models, which means that they have to pass a certain quantitative and qualitative tests, and in order to make this desk eligible to EMA, and they can use their own market risk models for the capital requirements calculation. The difference is that if they go for SA, typically in general, what happens is that they will have less capitals at the expense of, they will have more capitals at the expense of less costs and investments in IT and skills. If they go for internal models, they will have typically less capitals, but they will have, major, I would say, significant, bigger investments and bigger skills for implementing it. From an implementation perspective, the situation is quite, I would say, still to be completely stable. Let's say that the jurisdiction, the global deadline that has been set by the Basel Committee for Banking Supervision is Jan 2023. However, no banks will go live by that time, and it is up to the single jurisdictions around the world to decide, when they will go live. And typically, Europe has been a front runner until now because they have already announced under the CRR2 and CRR3 packages that they will go live in January 2025. In the other jurisdictions, in APAC and in the US, the situation is, again, not sufficiently clear. There are jurisdictions that have announced already their plans and others that they have not. For example, US and UK have not yet announced their deadlines, their plans for the FRTB enforcement date. However, the general sentiment is that over time they will align to the European deadline.
Thanks, Fausto. And clearly, quite a few moving pieces and in different situations there globally. You commented that the standard approach has changed from the previous regulatory framework, and that now I think it needs to be implemented at desk level. You mentioned. So, coming now to you, Attika, I'm hoping you can just please share what you see as the key aspects that really underrule this capital charge calculation under the standard approach that we're talking about today.
Yeah. Hi, Pietro, and thanks for the question. So, like Fausto said, there are two major changes, I would say, from the previous Basel 2.5 regulations. And one of them, which he touched upon, was the focus has now shifted from the enterprise level calculations to desk level calculations. So that has given a lot of granularity to risk charges and to capital requirement calculations. The other change is, I think, the capital requirement measurement, methods, especially the sensitivity-based method under the standardized approach, that's now focused on measuring the risk sensitivity of the position. So this quantifies the impact of the risk factor fluctuations on the assets and the portfolio valuations. Now, keeping this in mind, I think there are two major key aspects which underrule the capital charge calculations under SA, specifically the SBM. And those two aspects would be, the first one is the sensitivity calculation, which focuses on identifying the risk factors for different risk classes, and then mapping those risk factors to your positions, and then measuring the impact of these risk factor fluctuations on your assets and on your portfolio positions. So that's one aspect. The other aspect is the aggregation of the risk charges. So this focuses on incorporating correlations between various risk factors, between buckets, and so on. So I would say these are the two key aspects, the sensitivity and then the aggregation piece of it.
Thanks, Tika. Very clear. And I think quite clearly as well, there seems to be quite a large data angle that comes into play here. That's why, just turning it back to you, Fausto, in terms of the challenges that you're seeing from banks implementing the regulation, and especially focusing on some of the data challenges that you think that the banks are facing from what you've been seeing in your conversations?
Yeah, so I would say that first of all, what I'm hearing from banks, and back to what Attika was saying, for calculating the capital requirements under the SBM, you need to calculate the risk sensitivities, right? And the first thing that you have to do in order to calculate these sensitivities is to be able to map every single trading position to the relevant risk bucket, which has been predefined by the regulation, as well as the risk weight, right? So, for example, if you have a bond, which has been issued by a technology firm, right, with an higher credit quality, an investment grade credit quality, that bond, will go into a particular bucket with a particular weight. On the other side, if you have a technology firm that is issuing a bond with a credit quality which is lower, then it will go into another bucket with a higher risk weight, right? So this work of mapping every single trading position and the underlying instrument of that trading position into buckets and weight as defined by the regulation is quite a complex one, because this would require banks to have accurate terms and conditions master databases, right? And this is quite a very complex, I would say, type of requirement, and it's actually very challenging. And there may be data quality issues. For sure, there are data management issues to be tackled. And overall, banks, in order to fulfill this requirement, they need to get data from different data vendors in order to build this master database with all the relevant T's and C's in place. That's one of the biggest challenges that we are seeing. The other challenge is about the so-called look-through requirements, and that means that if a bank has got equity positions that refer to funds or refer to indices, right? What they have to do, they have to treat the single constituents of the funds or of the index, right, as they were held by the bank itself. And that's another big requirement, because this implies that for any given fund and any given index that is referred by a particular trading position, you need to decompose that particular fund and index in the constituents and weights. And again, the challenge here is that you need to tackle this requirement by sourcing data from external vendors, which can be costly, right? And at the same time, you can also adopt other types of strategies. For example, if you have an index, you can actually try to rather than taking the constituents of that index directly, you can actually use a proxy, for example, an ETF on that particular that is replicating that index, and get more or less the same results. Anyway, these are the biggest challenges that we are seeing as we speak with customers specifically on data. Of course, there will be others that I'm sure that Attika will be able to comment, but these are the main that I'm seeing from from a data perspective.
Oh, great! Thank you, Fausto. And actually, right as you mentioned, I mean, turning to Attika, I'm interested, especially to have your view from an implementation perspective purely.
Right.
What do you see there as the kind of challenges that banks are facing when they're actually calculating the standardized approach capital charges, and especially what drivers do you then see that pushes banks to outsource this calculation of third-party providers?
Right. So from implementation point of view, there are a few challenges. And of course, data requirement is the first and the foremost challenge because that's the input. And there is a variety of data which is required. I think Fausto covered it really well. But just, to highlight that, you require like risk factor mapping data, you require holdings data, transactions data. So that's a huge requirement. And that's one of the big challenges. Other than data requirement, I would say the bucketing. So SBM or sensitivity-based method, it has like certain bucketing requirements, which requires the banks or the corporates to basically categorize their positions or their assets into various risk buckets. And like Fausto said, I think bucketing is a major challenge which is being faced, and that's where data solutions come into picture. And then there is another challenge with the definitions of the sensitivities and the calculation methods. So these techniques are very specific to the FRTB regime. And for example, the interest rate risk class, it defines the risk factors across two dimensions. So it defines like a risk-free yield curve, but then it defines it across tenors. So it's the sensitivity is calculated like for each tenor. So it's different from your duration or partial duration kind of calculations. It's similar, but then again, it requires customization. So that customization piece, I think it's a little challenging because you have to develop specific models for FRTB. And I think another major challenge is the aggregation piece of it. So aggregation is a mathematical kind of a problem statement where there are correlations, there are risk factors, there is weighted sensitivities, and you need to aggregate all of these things into risk charge determinations. But then there are considerations around computing speed, there are considerations around dollar cost. So that becomes a little bit challenging for the banks to develop like cost-effective and efficient models. And from there, coming to the key drivers, which banks are, are pushing banks to outsource, I would say there are two, key drivers. And the first one is data requirement. The second one would be the computational cost and complexity. And depending on the bank's portfolio size and bank's portfolio complexity, they might opt to go for either, only data solutions like the Refinitiv FRTB data solution, or they can try to go only for modeling solutions, something like Yieldbook, or they can try to go for like a comprehensive solution which encompasses, everything, and it's like a full-blown, FRTB solution. So those are like the key drivers which are pushing banks into the outsourcing direction.
Great, thanks, Attika. And that's actually a really, really good leadway into my next thought, which I've heard both of you talking a lot about plenty of, let's say, kind of challenges that come around not only the data requirements but the customization required to actually make sense of the rules in FRTB, even on the standard approach, right? Apart from the internal model approach that we've also mentioned in the past. But keen to spend some time really on seeing how banks can actually get support to help navigate this regulation. And I'll turn to you, Fausto, first in terms of how Refinitiv specifically can provide in navigating the standard approach requirement.
Yeah, we have multiple data solutions for helping customers to navigate the SA. So first of all, for the SBM calculation, we have an offering in place delivered by our DataScope product family, by which we are delivering I would say the key ingredients for the risk sensitivity calculation, and in particular, the risk class, the risk bucket, and the risk weight for any given instrument that we have in our databases. We have millions and millions of instruments available in the Refinitiv databases, and now we are able to show for any given instrument, all the different ingredients that are required for the risk sensitivity calculation, Again, class, risk bucket, and risk weight. And in addition, we are also providing other ingredients which can give transparency about why we basically, for example, position a particular instrument for a particular bond, for example, in that particular bucket with that particular weight. And we have additional data fields that can give transparency about the buckets and the weights that customers can see for any given instrument. And these additional fields include, for example, the risk sector. They include the market sector, can include the market cap, can include other fields that are typically used for the calculation of the bucket and of the weight based on the SA rules. That's one offering that we have in place. Again, this is critical for the calculation of the SBM sensitivities. The other offering that we have in place is actually what we can help customers to comply with the look-through requirements. So we have an offering in place for providing for any given fund the relevant constituents and weights, right? And the same for indices. So we have an offering in place delivered by a different platform, which is called DataStream, that will allow customers to get hold of the constituents of any given index in terms of constituents and weights. And these are all ingredients that are critical for the look-through requirements, which is one of the key things that is actually one of the key challenges that banks are facing for SA.
Thank you, Fausto. And I'm especially interested now just to turn the focus to Yieldbook, Attika, which we're all very excited to have part of the Refinitiv family now. And it's been mentioned that Yieldbook, is one of the key capabilities that we now can provide as part of our FRTB solution. And I'd be interested just to hear from you in terms of just elaborating a little bit more on Yieldbook's capabilities, and especially focus on how that can help solve the capital charge calculation.
Right. So Yieldbook is a part of the London Stock Exchange Group's Information Services division, and it's a renowned market leader in fixed income analytics, and it has a special focus on complex and securitized assets. So it helps number of market makers and institutional investors. It helps them, carry on very complex and very accurate portfolio analysis and risk management functions, and everything specific to fixed income analytics. But then more generally within LSEG, we also have other tools to address most other asset classes, although Yieldbook is focused on fixed income. So our solution, basically, Yieldbook plans to offer a very robust and a customizable FRTB SBM solution with a focus on interest rate risk and credit spread risk classes. So how we have structured it is that, it has an FRTB modeling solution, but it can also be used alongside Yieldbook's fixed income, valuation engine, so that there is a seamless user experience. And along with this, what Fausto said about the FRTB SA data, the risk buckets, the risk weights, all of those things are being integrated into Yieldbook's engine, so that it will become a one-stop solution, for the clients, where you will have the data availability, you will have risk factor mapping, you will have sensitivity calculations, and also risk charge determinations for the interest rate risk and for the credit spread risk classes. Another thing we have is that we have the ability to provide a lot of risk factor market data as well. For example, the yield curves, the volatilities, all of those are embedded into the Yieldbook's engine. So like I said, it's a comprehensive solution. Right now, it's focused on fixed income classes, risk classes, but then in future, we also have plans to explore other, risk classes as well. So that's also on our radar, maybe for future, phases. So I think that sums up really well our capabilities.
Thank you, Tika. Great to see that we have quite comprehensive solutions in the space, and also quite a bit to come on the roadmap as well. So fantastic to hear. I think with that we've come to the end of this episode of Perspectives Live, and I want to just thank you to both Fausto and Attika for joining us today and taking the time to share your thoughts and expertise.
Thank you very much.
Thanks. It's been a pleasure.
Thank you both. And likewise, many thanks to our audience for joining today. We really hope you found this to be a helpful session. And if you'd like more information or support on any of the topics that you heard about today, please do get in touch using the link in the comments. Many thanks again for joining, and we look forward to seeing you again soon.